Welcome to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan, and today we're diving into a crucial topic that has everyone in the industry talking: the downward trend in fixed mortgage rates ahead of an expected Bank of Canada rate cut. This is episode 24, and as always, we're here to keep you informed with the latest developments, trends, and regulatory changes affecting the mortgage and real estate landscape in Ontario and beyond. This week's Mortgage Digest highlights the past week's key mortgage news, particularly the downward trend in fixed mortgage rates as lenders respond to lower bond yields. Over the past week, lenders have been chipping away at their fixed rate pricing, mirroring the drop in bond yields that we've seen over the course of the month. Since hitting a recent peak of 3.57% in early July, the Government of Canada 5-year bond yield has fallen by roughly 20 basis points, or 0.20%. This has led to small but steady rate drops for certain mortgage types and terms, generally ranging from 5 to 15 basis points, or 0.05 to 0.15%. Government of Canada bond yields were range-bound last week, holding on to their previous declines, noted mortgage broker and commentator Dave Larocque of Integrated Mortgage Planners. Fixed mortgage rates have started to move lower in response. Data from the Bank of Canada show that average 5-year fixed rates as of May had dropped to 4.90% for insured mortgages, those with a down payment of less than 20%, and 5.33% for uninsured mortgages. And rates have continued to ease since then. That's down from a peak of 5.54% and 5.78%, respectively, reached in November 2023. Meanwhile, discounts on variable rates have tightened up slightly, Dave Larocque points out in his latest blog post. Despite the tightening discounts, variable rate holders are likely to see their interest costs drop this week. Financial markets have fully priced in a second consecutive quarter-point rate cut by the Bank of Canada, set to be announced on Wednesday. This reduction in the central bank's policy rate will directly lower the prime rate, which in turn influences variable mortgage rates. Variable rate borrowers should expect a rate cut this Wednesday and several more to follow, Larocque wrote. I think the bank's policy rate is too high based on our current economic conditions. If the bank wants to skate where the puck is going, it will need to start hustling to get there. In other news, Canada's housing plan may bring prices down in some markets, according to the Minister of Housing, Infrastructure and Communities, Sean Fraser. Fraser said, "It's not my goal to bring down housing prices. My goal is to build more supply at prices that people can afford." He explained that some measures put in place to drive that supply could exert downward pressure on the price of homes in different markets. The plan includes financial incentives for home builders and adjustments to immigration policies to ensure a steady flow of skilled workers in the construction industry. Fraser emphasized the importance of balancing supply and demand to avoid exacerbating the housing crisis. Additionally, Infrastructure Canada announced a formal request for proposals for the first iteration of the government's Housing Design Catalog. This initiative, unveiled in Budget 2024, aims to streamline and standardize housing designs to expedite construction and reduce costs. Royal LePage has forecasted a 9% rise in average home prices in the fourth quarter of this year. In its latest forecast released last week, Royal LePage says the aggregate price of a home in Canada could reach an annual growth rate of 9% in the fourth quarter. That would be substantially higher than the 1.9% year-over-year growth rate recorded in the second quarter, and is expected to be driven by subsequent Bank of Canada rate cuts in the second half of the year. According to Royal LePage poll results, 51% of sidelined homebuyers said they would resume their search if interest rates reversed. The agency noted that the Bank of Canada's June rate cut has yet to significantly boost real estate activity, resulting in a buildup of housing inventory and continued downward pressure on house prices. Canada's housing market is struggling to find a consistent rhythm, said Phil Soper, President and Chief Executive Officer of Royal LePage. Nationally, home prices rose while the number of properties bought and sold sagged, an unusual dynamic. The Royal LePage House Price Survey reported that the aggregate price of a home in Canada rose to $824,300 as of the second quarter. When segmented by housing type, the The national median price for single-family detached homes rose by 2.2% over the past year, reaching $866,600. Similarly, the median price for condominiums saw a year-over-year increase of 1.6%, climbing to $596,500. Despite Canadians feeling slightly worse about their finances, the latest weekly Nanos Consumer Confidence poll showed an improvement in how they view real estate. The poll found that financial concerns are growing, with a reading of 14.76, down from 15.28 last week, and the 6-year average of 17.90. People are 3 times more likely to say their personal finances are worse rather than better compared to a year ago, noted Nick Nanos, chief data scientist. The weekly telephone poll included responses from 1,120 Canadians. Meanwhile, optimism about the real estate market is on the rise, with a reading of 47.74, up from 46.42 last week and a long-term average of 40.11. However, that's down from 49.22 4 weeks ago. Overall, the results show consumer confidence moved down slightly to 53.19 compared with 53.95 4 weeks ago, and a 2024 average of 52.82. Looking at other specific measures of consumer confidence, sentiment on the Canadian economy deteriorated compared to last week, while sentiment towards job security improved marginally. That wraps up our weekly Mortgage Digest for this episode. Stay tuned as we continue to bring you the latest insights and updates in the mortgage and real estate market. I'm Steve Hamoan, and this is the Ontario Mortgage and Real Estate Insights podcast. In major Canadian real estate markets like Toronto, Vancouver, and the Fraser Valley, inventory levels are surging. It appears that last month's interest rate cut was enough, or not enough for those in need of a bigger cut, to coax many sellers back into the market, giving would-be homebuyers more choice and pushing conditions towards buyers' market territory. There's one major caveat, though. Buyers aren't really biting. The latest figures from the Toronto Regional Real Estate Board, released earlier this month, showed that sales slumped 16.4% on a year-over-year basis in June, with just 6,213 transactions recorded. Things were similarly quiet in Vancouver and the Fraser Valley, where there were just 2,295 and 1,317 sales recorded respectively in the month, representing annual declines of 19% and 30%. By contrast, new listings surged to 17,964 in Toronto, 5,723 in Vancouver, and 3,418 in the Fraser Valley. Taking all of those figures into account, the sales to new listing ratio, calculated by dividing the number of homes sold by the number of new listings recorded, clocked in at around 34.6% in Toronto, 41.8% in Vancouver, and 38.5% in the Fraser Valley. Anything under 40% suggests a buyer-friendly market, while a ratio between 40% and 60% indicates that buying and selling conditions are more balanced. Conversely, a ratio that's 60% or higher indicates a seller's market. While, in theory, we're either already in or on the cusp of a buyer's territory in these major Canadian markets, John Lusink, president of Right at Home Realty and Property.ca, points out that for a buyer's market to truly exist, you need to have real buyers. Underscoring how slow things are these days, Lusink points to COVID times, when his brokerages were seeing half the amount of listings, but around 25% more transactions. His take on the matter is that there is plenty of pent-up demand. Buyers do want to buy, but in many cases they aren't able to qualify in the current interest rate environment. And despite the fact that interest rates are finally starting to come down, he warns that it will take mortgage rates some time to catch up. The question is, at what point will buyers then be able to return to the market? Is that going back to when mortgage rates were in that 3.5% to 4% range? Yeah, that probably would help. We're sort of in the low to mid-sixes at the moment, depending on what product you choose, Lusink says. I think the sense also is that prices need to come down for buyers to say, okay, I'm stepping up. Although Lusink's thinking is that the Bank of Canada will lower the policy interest rate again this week, the next announcement is on Wednesday the 24th, he doesn't think that will be enough to entice buyers to, well, buy. Not yet, anyways. Ross McCready, president and chief executive officer of Sutton Group, is in the same camp, telling stories that while he thinks a rate cut would have an effect on market sentiment, he doesn't think it will open the floodgates, so to speak, as far as actual home sales go. Interest rates are just one piece of the larger housing inaffordability puzzle, McCready says. You've had interest rates go up very, very fast. And then you've also had your property insurance go up, your HOA fees go up. When you add all those costs up, people are seriously thinking, well, maybe I don't need to buy a house, maybe I should rent a condo or something like that. Even so, McCready anticipates that home buying activity will pick up to an extent in the fall and winter, which is when many mortgage holders will be up for renewal. People are going to start having to really cut back or consider selling their home and moving into something smaller, he says. And so you'll see people that have probably been sitting on the fence wanting to buy, who will step forward and buy. Demand is still there, McCready adds. I mean, we had 1 million new people come to Canada this year. That's an extraordinarily high number, and it's putting a lot of pressure on housing. For the time being, LoosInc urges those in the market to purchase a home to take advantage of the emerging buyer's market conditions, including more choice and the luxury of time. You finally have a little bit of time to study what's out there, get pre-approved, put in your conditions, all of that good stuff, he says. There are also opportunities in the new construction area where, unfortunately, people aren't able to close, or may be closed, but really aren't able to hang on. I think there's just lots more opportunity. Now let's talk about what mortgage shoppers in Canada need to know in this current higher interest rate environment. Leah Zlatkin, a broker with Mortgage Outlet Incorporated, recently shared some valuable insights with the Financial Post's Larissa Harapin, and I think it's crucial for our listeners to hear this. Firstly, Zlatkin emphasized the importance of understanding the pros and cons of longer amortization periods. Extending the amortization period can lower your monthly payments, making the mortgage more affordable in the short term. However, the downside is that you end up paying more interest over the life of the loan. This is a significant consideration, especially in a high interest rate environment where every percentage point can add up over time. Zlatkin also shed light on the best length of term for your mortgage. With interest rates being relatively high, she suggests that a 3-year fixed mortgage could be a safe bet. This term length offers a balance between not locking yourself into a high rate for too long and not exposing yourself to too much rate fluctuation in the short term. It gives you a bit of breathing room while also providing some stability. Another critical point Zlatkin made was the comparison between variable and fixed rates. While variable rates might be lower initially, they come with the risk of increasing over time, especially in an uncertain economic climate. Fixed rates, on the other hand, offer stability and predictability, which can be particularly valuable when budgeting for the future. Given the current environment, Zlatkin leans towards recommending fixed rates for most homebuyers. It's also worth noting that the mortgage market is highly competitive right now. Zlatkin advises mortgage shoppers to shop around and compare offers from different lenders. Sometimes, even a small difference in rates or terms can lead to significant savings over the life of the mortgage. Don't just settle for the first offer you receive. Take the time to explore your options. Lastly, Zlatkin pointed out the importance of getting pre-approved for a mortgage before you start house hunting. A pre-approval not only gives you a clear idea of how much you can afford, but also makes you a more attractive buyer to sellers. In a competitive market, having that pre-approval can give you an edge over other potential buyers who haven't taken that step. So, to sum up, when shopping for a mortgage in the current higher interest rate environment, consider the pros and cons of longer amortizations. Think about opting for a 3-year fixed term, weigh the benefits of fixed versus variable rates, shop around for the best deal, and get pre-approved to strengthen your buying position. These steps can help you navigate the complexities of the mortgage market and make a well-informed decision. Now, let's shift our focus to a significant development in the property tax landscape in southern Ontario. According to a recent report by Zoocasa, Mississauga has experienced the highest year-over-year property tax hike among cities in the region. Homeowners in Mississauga saw property tax rates climb by 7.39% from 2023 to 2024. This increase is slightly higher than Toronto's tax hike of 7.36% and Scugog's increase of 6.78%. The report compiled and ranked the 2024 residential property tax rates for 30 cities across the Greater Toronto Area using data sourced from each municipality's website and average year-to-date home prices from the June 2024 Toronto Regional Real Estate Board report. It revealed that the tax rate in Mississauga is currently 0.946649%. To put that into perspective, people living in a property appraised at $500,000 pay $4,733 a year. Homeowners in properties worth $750,000 pay $7,100, and those in homes valued at $1 million pay $9,466. The average home price in Mississauga is now $1,074,907, when considering all home types combined. These tax rates and the substantial year-over-year increase are certainly noteworthy for current and prospective homeowners in the city. The report notes that towns and cities decide on their property tax rates yearly, considering their own unique budgets. These taxes are calculated by multiplying the municipality's residential tax rate by the assessed value of a home, which is decided by the Municipal Property Assessment Corporation, better known as MPAC. Property taxes fund essential services, such as police and fire departments, infrastructure maintenance, schools, waste collection, snow removal, sewage upkeep, and more. Interestingly, the report also mentions that in towns and cities with higher populations, residents might pay less because there is a larger pool of residents from whom to collect taxes. This is an important factor to consider when comparing property tax rates across different municipalities. Despite Mississauga having the highest year-over-year increase, it is important to note that residents do not pay the highest property taxes in the Greater Toronto Area. According to the report, some towns and cities with higher tax rates include Brampton, Pickering, Ajax, Whitby, Barrie, Oshawa, and Orangeville. On the other hand, towns and cities where residents pay less include Toronto, Markham, Vaughan, Richmond Hill, Oakville, Burlington, Caledon, Milton, and Halton Hills. Understanding property taxes is essential for budgeting, whether you own a home or are considering buying one. Even if you have reached a mortgage-free status, you will always have to account for them in your finances. The report emphasizes the importance of being aware of these costs as they can significantly impact your overall financial planning. Our next segment features insights from Kate Ricci, a realtor with Century 21 Blue Sky Realty Incorporated brokerage in North Bay. Kate recently shared her expertise on the podcast To North Bay with Love, hosted by Lisa Boyven. Kate offers a grounded perspective on the current real estate market in North Bay, which has been listed as the 5th best place to buy real estate in Canada by MoneySense. Kate describes the market as a mixed bag, noting that listing agents, including herself, are finding it challenging to price homes accurately. She emphasizes that while people want a lot for their houses, the market does not always align with those expectations. According to Kate, too many people, not enough houses, and people don't want to compete. Even when houses are underlisted, they might still receive multiple offers, often exceeding the asking price. However, Kate warns that this is not always the case. There could be aspects of a house that sellers overlook, but buyers see as significant issues. That could be a busy street, or it doesn't quite have those really nice finishes, she explains. Maybe it needs work in the backyard, or it has a leak that needs to be fixed, and the buyer just sees that as extra work. Kate stresses the importance of patience and empathy when working with clients. Buying and selling a home is a major life event, she says. People are emotionally attached to their homes, and they feel it's worth a certain amount of money in their minds, and that's something I have to respect. She even likens her role to that of a therapist, highlighting the need to build trust and relate to clients on a personal level. One interesting point Kate makes is about the impact of new builds on the market. North Bay is experiencing growth with new developments, especially in areas like East Ferris, Callander, and Sturgeon Falls. The city is expanding new subdivisions, and waterfront property is definitely more than your average lot, she notes. The land value for waterfront properties can be significantly higher, sometimes by as much as $100,000. Kate also offers practical advice for homebuyers. She emphasizes the importance of getting pre-approved by a lender before making an offer. I did one deal where the buyer said they were pre-approved, but they weren't actually pre-approved, she recalls. This underscores the importance of having official pre-approval to avoid disappointment and complications. Additionally, Kate advises first-time buyers to always get a home inspection, even for newer builds. Get someone to go through it with you to make sure you understand what everything means, she says. This step is crucial for understanding the condition of the home and avoiding unforeseen issues down the line. For those looking to manage their mortgage payments better, Kate suggests considering properties with rental options. If the property includes a rental option, someone who can live in the basement and help you pay your mortgage, that's a great way to ease the financial burden, she explains. This strategy can make home ownership more attainable and help build wealth over time. Kate concludes by emphasizing the long-term benefits of home ownership. I don't want people to be afraid of home ownership. This is how you get ahead in the world, she says. While renting might seem more convenient, owning a home is an investment that can pay off significantly in the future. In closing, Kate highlights the importance of loyalty and customer service in the real estate industry. You sell someone a home, and hopefully as a realtor, you gave them an enjoyable experience so they come back to you on their next home, she says. Building trust and taking care of clients can lead to lasting relationships and repeat business. That wraps up our discussion for today. A big thank you to Kate Ricci for sharing her valuable insights on the North Bay real estate market. As always, stay tuned for more updates and expert advice on the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hammond, signing off until next time.